Hi guys, welcome back. In today's video, part 8 of the hospital series, we are going to be covering a very chotu sa company in the hospital space called as Asarfi Hospital Limited. Okay, the IPO of this hospital has come. I think it's been a year since IPO has been there. I think more than a year now. But recently, you're seeing a little bit of spurt of growth, and the management has been very bullish in terms of guidance. So let us look at this opportunity that is there. Okay, so, like I told you, Asarfi Hospital, if you look at the market cap of the company, it's quite small of a company, okay? Like one below 200 crore ka market cap. Hai. The market cap is hardly 167 crore, okay? So, over here, what does this hospital do? When you look at the hospital ka revenue, there are two streams of revenue basically. One is a hospital, and the other one is your pharmacy, okay? So, over here, hospital contributes roughly 60 to 70% of the revenue, and the rest of the revenue comes from pharmacy business, okay? And this pharmacy business, of course, you have two types of pharmacy. One is your inpatient ka pharmacy and outpatient ka pharmacy. Now, what does this inpatient and outpatient pharmacies? Let's say outpatient is, you let's say you are not admitted in the hospital. Like you come probably for a consultation and the doctor prescribes you some medicine and you're just going at that pharmacy in the hospital and you're buying. Inpatient pharmacies, let's say for example, you're admitted in the hospital and they will give you, they will write down all these things like you have to get the drips and that, and then you have to go and purchase from that retail pharmacy that is there in the hospital itself, right? So this is the difference between intail and outtail ka pharmacy that is there. Okay. Now, like I told you, it just outline of the business. If I have to give you, 60 to 75% of the revenue comes from your what do you call that, hospital business, and the other 25 to 30% comes from your pharmacy business. Okay. These people are a very small hospital. They are located in Jharkhand, in a small town in Jharkhand. They are located in the region of Dhanbad. So now they have two hospitals. First hospital is a 250 bedded hospital. Okay, this has been for a very long period of time. And recently, after the IPO had come, they had raised around 27 crores. A part of that has gone to buy a land and construct a cancer hospital, which is basically a 50 bedded hospital. Again, similarly in Jharkhand, only in that adjacent area, they've bought a hospital. So now they have two hospital. One is a 250 bedded, very big hospital, and the other one is just started recently in 2024, which is a 50 bedded hospital. It is specifically for cancer and cancer related treatments only. Whereas the first hospital, 250 bedded, is a multi-speciality. This new 50 bedded hospital is a cancer hospital. So total number of beds as of this H1 FY25 is 300 beds. Okay. So now you got the gist of the business. Okay. Now let us talk about the numbers that are there. Okay. So if you look at the numbers, I will just share the screen. I think that would be better. Okay. Screen is shared. Yeah, yeah. Can you see? Like I told you, there are two hospitals. One is this Asarfi big hospital that I was talking about, which is in Dhanbad, 250 bedded, and recently started small hospital in Jharkhand, which is a 50 bedded hospital. Now let us go towards the top. Let us see the numbers. If you look at the numbers, you see that, yeah, where is the numbers? So basically, the sales, first of all, the sales grew by 33.4% on a 33.4% if you look at it on a H1 versus H1 basis. If you look at the EBITDA also has increased. EBITDA margin has also inched from 20 to 22%. If you look at the 20 to 22%, 20 to 21.6 on a H1 versus H1. I don't know if this is visible. I can't see the numbers. Yeah. Anyways, next, looking at the profit after tax, can you see profit after tax also has gone up from 206 crores to 443 crores, right? Profit after tax has literally been up by 114%. And if you look at even the PAT margin also has improved from 5 to 8%. So now what is the reason that these people are having such high growth? Like, because if you compare all the hospitals that are there, right? I think the maximum growth that you're seeing is in Yatharth, which is 25, and Max, which is 25. After that, Apollo was 15, Aster DM Healthcare was 16, KIMS was 19, Narayana Hridayalaya was 7.6, Global Healthcare was 12%, yeah, 10%. GPT Healthcare sales was degrowing 2.1%, as much as I remember, sales degrew, right? Am I missing something? Jupiter grew by 20%. These are the sales growth that I'm talking about on a year-on-year basis, that is Q2 on Q2. These people haven't given Q2 on Q2, but they've given H1 on H1. Even similarly, if you look at H1 versus H1, you do not see any hospital that is inching at least more than 30% kind of growth. This is the only hospital that has grown by 33.4% on a year-on-year basis, not just grown. You saw that one common trend among the hospital spaces, most of them don't have any kind of operating leverage. Why the operating leverage is missing is because all of them are doing so much capex that all the pat is getting squeezed in expenses, right? So as a result, operating leverage is missing. These people are not just growing. EBITDA margin is also quite good. 22% is something, 22 to 25% is the average you would see in any hospital. And not just that, they're having an operating leverage also. You see that the PAT also has grown by this rate, even the EPS has grown by a similar amount, right? So what is the reason for this? So there are two things, there are two reasons for this, like I told you. One is, of course, if you look at your hospital that I told you, the cancer related hospital, it got commissioned recently, right? So when, of course, when a new hospital comes to your portfolio, obviously there वहां से थोड़ा occupancy आएगा, वहां से थोड़ा ARPOB also will come. Another thing, what did I tell you? This 50-bedded hospital that you see, that the cancer hospital that they've started, like I told you, it's a cancer related hospital. So of course, if you look at it, any department or any hospital that has oncology as a department, and if let's say a major part of the revenue is coming from oncology, then that hospital is bound to have more ARPOB, is bound to have more margins, because oncology as a treatment is quite expensive when you charge to the customer, and of course it's a repetitive treatment. Let's say because if you're coming for chemo, you have to come again and again, right? As a result, it is way more expensive and your margins increase. In fact, I'll tell you, whenever you compare any ARPOB, you will see that for a normal treatment versus cancer treatment, the ARPOB is 2x the average revenue per occupied bed. If you're treating, say, let's say for a normal specialty versus a cancer specialty, you get 2x more the ARPOB compared to, let's say, that. Not just the ARPOB, the margins are also higher, the PAT margins are also higher, right? So that is the reason you see, because of the new hospital getting commissioned, you see that growth. Okay, now let us talk about the hospital KPIs. We saw that in terms of the company, in terms of the income statement, we saw all of the parameters: sales, EBITDA margin, PAT margin, EPS, everything is going really well, right? Now let us talk about the occupancy, right? Now let's see over here. Can you see occupancy in the last FY24 was 58%, now it is 60%, right? Yeah, occupancy rate, can you see? It was 58 versus 60%, not that much of an improvement. But over here, can you see the ARPOB has really gone up, 18,000 to 19,524, right? So that, see, the ARPOB is the major driver factor of growth over here than anything, let's say, occupancy. Okay, now this is all about your as of now, as of Q2 or as of H1 FY25. But what is so special about over here, what is so special about this hospital is, you have to look forward to see if they will be able to maintain this pace of growth. Like, is this one quarter call expert, and will they go like, push in the coming quarters? How is it? That is the most important thing. So this company, like I told you, right, they raised 27 crore in terms of 26.9 crores in terms of IPO, right? Out of this 26.94 crores, can you see they have allotted 7 crores odd for your general corporate purpose, right? Could be change in management, all of those things. And then other than that, they have invested that Capex amount into two places. One is this Capex is to the cancer hospital, like I told you, this new cancer hospital. Okay, I'll come down to this later. And okay, anyways, and the other part of of this has gone into building a research institute, basically a medical research institute. You can tell that is what it is. Now, this is where the change is coming from. So what is the Capex plan that they're targeting right now is, like I told you, this cancer hospital that they have, new one that they have. As of now, this hospital has only 50 beds. That is it. It has only 50 beds. They are planning to take from this 50 beds to, they're going to add additional 150 beds. Okay, this is Capex number one. As of H1 FY25, this hospital is having an occupancy of 57%. Okay, by the way, you might see over here, a lot of y'all might have confusion over here is, when you read the PPT, you will see here, this is 25% occupancy, you will see over here. And here for the same hospital, they've given 57% occupancy. Now, what is the difference over here? I'll tell you. Already this is at 57% occupancy as of H1 FY25. It is not 25, it is 57. So they will take from this 57 to 75. Now, of course, what is your occupancy denominator in the formula? The number of beds that are there. What they're telling in the next coming 1 year, 1.5 years, they're going to add another 150 beds going forward, right? They will add another 150 beds. Of course, when the base increases, the occupancy levels will change. So if they add this 150 beds into the current base, then the occupancy is 25%. So after that, going forward, they're targeting this 25% to take as the base will increase. They're targeting from 25 to 75%. Okay. First is the existing 50 beds that are there, that they will increase the occupancy to 75. Then going forward in the next 1 to 1.5 year, that in the next coming year, what they will do is they will add another 150 beds in the cancer research unit, and they will take this also to 75% of beds. Okay. So this is the main thing over here. And as a result, like I told you, that if you have cancer as a specialty, your RPOPs is bound to increase. Okay. Now over here, this is as a result, you'll see this is the guidance they have given. Okay. Like we covered first the result, we covered the hospital KPIs, good in terms of result, good in terms of hospital KPIs. Then we came to Capex. Capex was also really good over here. Okay. I wouldn't say really good. Okay. Decent. Okay. Nothing to be excited about. Okay. Now, as a result, because of this Capex, they're giving this vision as to like how things will pan out in the coming 1.5 year. Okay. So as of now, can you see as of H1FY25, these are the metrics. Okay. They're growing the CAGR at 18%. The number of beds at 300. Here it is 21.4. Here it is 7.7. PAT margin 9%. So from here, they want to take it to all of these things. Okay. Now let us do a small basics calculation. Okay. Like what can we expect from here? Of course, here PAT margin is increasing. Can you see 7.7 to 11%? PAT margin is increasing. Even your return on capital employed is increasing. Okay. What are they telling over here? 18% से हम लोग 29% से CAGR we will grow for the next few years. That is FY25. We have another 6 months of FY25 and 1 year of FY26. Right. So if you take FY24 ka revenue is around 81 crore. Okay. You do a backward calculation. 81 crore is the FY24 ka, revenue. In the next 2 years, you'll be targeting to grow at 29% CAGR. So in that case, what will be the revenue for FY25 and FY26? Roughly, you will get 104 crores and 135 crores. Okay. Now, PAT margin is how much? 7.7. How much are they targeting by the end of the year? 11.1. Right. I'm going to keep the same PAT margin, 11.1 divided by 100. Okay, so 0.11 into 104. FY25 PAT, again, assuming that the PAT margin will inch up even in this year to 11%. FY25 PAT, we should be seeing around 11.5. Let's say if it is 134 crore. 11 divided by 100. FY26 ka revenue expectation is how much? 134 crore. Into 134 crore. How much is the net profit we are expecting for FY26? 14.7. Okay. Let's say in this year, they'll probably not be able to inch up to 11%. Beach ka they will do 9%, right? So 9 divided by 100 into 104. 9.36. So this year in FY25, they can do somewhere between 9.36 to 11 crore. And next year, they should be able to do around 14 crores in PAT. Okay. Now, how did we get this? Again, simple. You know that the revenue right now is, in FY24, revenue is 81 crore. In 2 years, they're planning to grow at 29% CAGR. Backward calculation, if you do, you get 104 and 134 crores of revenue in FY25 and FY26 respectively. That's number one. Second, what we did was we have to find out PAT, right? So we know that PAT margin is net profit divided by revenue. Okay. So we know that PAT margin is going to be 11%. We got the revenue, multiply it, you got the net profit, right? And in this case, why I'm taking 9.36 is because they're telling the PAT margin will be in FY26, right? So I took beach ka scale, probably it could be 9%, not not 11%. So that is why the PAT can range either from 9 crores, 9.3 crores to 11 crores to 14 crores. Okay. So now, like I told you, sales growth is 80%. Now, sorry, 80 crore. Anyway, sales growth is 80 crore. So 80 minus 104 divided by 80. Sales growth sales growth over this year, FY24 versus FY25 is going to be 30% kind of growth you can expect. Then other than that, let's talk about the PAT. PAT is around 4.16, right? And we were expecting minimum of 9 crores, right? So 4.1 minus 9.3 divided by 4.1 is around 1.2x time you're going to see increase in PAT. So you're going to see immense operating leverage. If it is around 11.2 or 11.3 crores, it is almost 3x in PAT, you can assume, right? And similarly, if you see for the FY26, if you look at the base right now, it is again, it will increase from 104 to 136, a good 30% ka CAGR. And also you see, even in terms of PAT growth also, right now it is 4. In 2 years, if you see, if it is targeting around 11 crores in PAT due to increase in margins, right? Then how is it? The PAT will again, it will be roughly, you can tell, a growth of 3x in PAT. Now let us talk about the market cap. Like I told you, market cap is 166. 1 year forward P calculation, if I do 166 by 9 is 18p, 166 by 11 is 15, 166 by 14 is 11.8. So the 1 year forward P ranges between 18 to 11.8. How did I get? Again, what did I take as PAT is a different case scenarios that I just showed you, right? Based on that, those are the 3 PATs that we got. You saw that the 1 year ka forward P goes from 11 to 18, right? Let me stop presenting. So now you understood the everything, right? We saw that the revenues were great. We saw that the Capex plan is there. Hospital KPIs were great. And you have a vision for the next 1.5 years. And from that, we got the guidance that, we got the 1 year forward P from the guidance that is mentioned. It is somewhere between 11 to 18 ka forward P. Okay. Now you might think like, 30% ka growth engine hai, 11 se 18 P mil raha hai, like, all must be nice, all must be hunky dory over here, right? Now, of course, there's always a but that is associated. These are all the good things that I told you about the business. Now let us talk about the risk. One is, of course, that is the risk that is there with every business, that is the execution risk. They might not be able to pull it off. Let's say they put up this 150 beds in the cancer hospital. Probably in the next 1.5 years, it becomes very difficult for them to achieve that occupancy level, right? Probably it is not possible. That is one thing. Another thing I forgot to mention over here, in that cancer hospital that I told you they're putting up, they have received funds from the Jharkhand ka government. They have received a subsidy of 12.9 crore also to build it up. So no pressure in terms of building hospital. But here comes the thing. If a hospital is giving you, if a government is giving a hospital a subsidiary, then you're bound to reserve a certain set of beds in your hospital for the government. Okay. As of now, if you look at this Asarfi hospital, 35% of the revenue comes from your government payer mix, right? This can go ahead and increase, which means what? The more your government payer mix increases, your receivables has a chance to get stuck over there. You have a chance to your receivables will increase, right? So this is one risk. Another risk, the government payer mix can increase because of the subsidiary they are receiving. As a result, receivables can increase. Third thing over here, like I told you, the only Capex that you have is for FY26. That is it, right? And it is not a huge addition in terms of bed also. You're going from 50 to 150 beds. That's roughly 100 beds that you're adding. Not a huge, I know in terms of percentage, it is huge. But if you look at other hospital, at that base, they're adding so many hospitals. So it is nowhere a competition to the other people, right? In fact, if you look, I told you, right? In terms of their Capex, they're only doing Capex in the cancer hospital. The other big Capex is they're putting up this research or this medical center that they're putting up, right? They're going from a hospital business to they're going to a educational business over here. And the market will not like the fact. Of course, happy return ratios are improving. Of course, you hold a chance to make money and all. But having said that, there is a reason that this company will always be at a discount valuation compared to the likes of other people, is because of over here, there is a change that is happening in terms of industry. If I have to put it in more better terms, if you remember Raymond, right? Raymond, if you remember, they were a lifestyle company. They were an apparel company that went into real estate and that went into this tools and engineering. So what happens over there is, in these cases, what happens is market doesn't like you're changing from one industry to other industry. It's becoming like a mixture over there. And always in these cases, the valuation will always get discounted over here. It becomes very hard for you to value that business or even compare it with the other peers also. So this is another thing, right? See, like I told you, there's always a reason whenever you see something is being very sasta in the market. There is always a reason. And this is the biggest thing, because if they were, let's say, using that same money and putting up another hospital over there, right? Which means what? They could have put up another 100-bedded hospital. Then they're basically doubling the Capex in less than 2 years. Wow, Yatharth to chodo. It would have been such a great competitor to Yatharth then, because Yatharth is doubling the bed capacity in 3 to 4 years. You're doubling the bed capacity in what? 1.5 to 2 years, right? So you don't see that. It is not even a competition over here. That is why it can never be a competition to Yatharth, is because of this growth rate. See, ultimately it is not about growth rate. Growth rate is not the only thing. You need growth as well as several other factors to come in conjunction for your stock to make money. यहाँ पे growth rate तो है, it is highest growing company among the hospital space. But until when is the question, because going forward यहाँ पे there is no additional bed capacity that can incrementally give you the growth, which will happen for Max, which will happen for Yatharth, for Jupiter, for Global Health, Medicare and all. But over here, this research medical center that you're putting up now, that is dragging the valuation down. That is a huge problem. The other thing, the last thing I would say over here is, I think I've covered all the points. I don't know if I'm missing something. I must be missing something. But yeah, these are the 4 main points over here I would like to see. Yeah. The last point is the management has told, okay, like going forward, right? They are planning to add 1,000 beds in the next 10 years. Now we are a 250 bed, 300 bedded company, 300 bedded hospital, and from 300 bed, you're planning around 1,000 beds in the next 10 years. There you have Yatharth, Max, are like doubling the bed capacity in 3 to 4 years, and you're telling 300 to 1,000 in 10 years. Then imagine the CAGR, what is the CAGR of this company, right? In fact, so that is why you see market is discounting over here this valuation, because even the market knows like jo bhi hai bhai ye sirf FY26 ke liye with the existing hospital, after that growth probably may not be there, right? Because with the other hospital there is a visibility of growth probably because of the capex, but here you see na 300 beds se 1,000 beds ja raha hai in a span of 10 years. In fact, they're telling right now 80 crore it is there in FY24, and they're planning to take this 80 crore to 400 crore in the next 10 years, right? That is literally like almost, you can tell, 5x the revenue in the next 10 years, right? Like that is like what, like a 15 to 18% ka CAGR engine that you're getting, right? And that is why, if it were, let's say right now the management was telling like we will 3x the revenue in the next 3 years, like how Sky Gold has done, if somebody is telling like that, then obviously market will give you above. There is always a reason why market doesn't give you above. There is always a reason why you don't trade at the same valuation as your peers when you're growing at a faster rate. And this is the reason for that Asarfi Hospital Limited, right? One is the bed capacity is not that strong. The growth rate going forward in the future can stall. And yeah, the discounting by adding another segment, which is completely different from your existing business model, right? So these are the 3. So of course, there are good pointers. There is also bad pointers. I've also done the valuation calculation also. We have given you all the things, the business model, the Q2FY25 result, the guidance, the valuation we discussed the good, the bad, and the ugly of the business. And it's up for you all to decide now, how do you view the business? Let me know your views in the comment section. And that's that for today's video. Yeah, that's that for today's video. See you again tomorrow. I think the only thing, again, I'm just wrapped up with the entire hospital space. Everything is done. The only thing that is left is to do a P2P analysis. I will take some time to do it because honestly, I'm just bugged after doing the hospital space. When I want to do a different sector. So we will do that later, probably a couple of days later. But for now, that's that about the hospital space.